Welcome back, everybody, and Happy New Year. I want to talk to you today not about a forecast for 2025, because if you've spent enough time with me, as I know a lot of you have, you'll know that forecasts are not only useless, they're dangerous. So anybody who has a forecast for 2025 about the stock market, about the economy, about anything, just bear in mind that there's always a chance, or a very high probability, that they will be absolutely wrong. It's better to prepare than to predict. Instead of that, I'm going to give you 11 of the pitfalls, the things I would like to avoid and you should try to avoid this year. 11 ideas and concepts that you should avoid. The first one is overlooking convexity in a portfolio design. Over the coming months, I'll be harping on the idea of convexity, exposing yourself in a positive way to low probability but high impact events. A collection of options, both on the long side and also on the short side. What do we mean by that? Well, stick with us for the year, but very basically speaking, do not overlook the concept that for a small amount in the options market, you can insure your portfolio against disaster. And on the other side, for a small amount, you can potentially replace or mimic the returns that you would get in a much less capital efficient way. Number two, this should be a basic one to many of you, failing to conduct deep fundamental research. What does that mean? If you're looking at a company or you're looking at an industry, you should be considering the competition. Investors today, at their fingertips and for free, have the ability to go onto the internet and find annual and quarterly reports of any publicly traded company. You could go to investor relations websites. There's even free sources of information to help you analyze these companies. Try to avoid this failure, conducting deep fundamental research. Third piece, neglecting risk management. If you neglect risk management, sizing positions appropriately within your risk parameters, using options as a protective measure, replacing highly appreciated stocks with more thoughtful structures, you're neglecting risk management. Now, risk isn't just the wiggles in the portfolio or short-term volatility. Risk is defined as permanent impairment of capital. So when people try to define risk in terms of beta, in terms of volatility versus the market, ignore them. Risk is permanent impairment of your capital, and you want to manage for that. Number four, chasing trends without understanding cycles. This is one that I love to discuss and that we'll talk about all of 2025 and as long as I continue to live. In the past 25 plus years of investing, I have seen so many people make this mistake. There are cycles to everything, and too many people mistake a trend for a cycle and vice versa. That's happening in the market as we speak. Number five, ignoring value and quality factors. You want to avoid this sin. It is often a very attractive thing to go and ignore value and ignore quality, either pay up for something that really isn't a good quality business or buy something that just looks cheap and isn't really a good quality business. There's art to this. I mean, the science is obviously the math, figuring out the valuation. The science is determining whether or not you're getting more quality than what you're paying. Another thing that people are avoiding and that they're underestimating and that you shouldn't is you're underestimating small cap opportunities. Small cap opportunities, I think, with the Magnificent Seven and the very large cap tech stocks having outperformed, they are there, and there are many of them this year as we look at the market. If you fail to appreciate the fact that there are opportunities for the smaller investor to go into the smaller cap stocks, you're going to miss great opportunities. Number 7, avoid this. failing to backtest and validate strategies. There's nuance to this. We'll talk about this throughout the year, but looking back and seeing what works across similar situations, right? We have the benefit of history to look back and validate your ideas, backtest your ideas in a more rigorous sort of way. If you fail to do that, you're giving yourself a disadvantage. Number 8, misunderstanding behavioral biases. We all have them. Very simply, you don't want to pigeonhole yourself as a growth person or a value person. You're a make money person. So you're all, myself included, we're all going to have behavioral biases, and we want to understand them. We want to know thyself. Number 9, and I harp on this as well, overlooking the power of options. You have an opportunity in the options market often to do two things. Replicate a long position, in other words, with a smaller amount of capital, have exposure to that long position. But you also have the ability on the other side to hedge positions, either in a simple way to write covered calls and make some income off highly appreciated, but maybe too appreciated, overly appreciated stocks, but also to truly hedge, to buy puts against the indices. Avoid ignoring them. Another thing I'd like you to avoid this year, avoid ignoring the macro and regulatory environment. I don't want you to become a macro investor if you don't want to be one, but I do want you to be attuned. A lot of people in 2007, before the 2008 crash, ignored the macro factors. They said, I'm a bottoms-up value investor. I'm going to ignore what's happening with interest rates, with banks, with ninja loans, all these different things that were right there. In retrospect, the macro factors, the fact that the credit world was overheated in 2007, it was staring at you, and there were good pundits talking about it. Think about macro issues in the markets today. Also think about the regulatory environment. We have a new president coming in a few weeks, 3 weeks to go. You'll see some different regulatory regimes that come, some of them good, some of them potentially dangerous, but to ignore these factors, to ignore the fact that there's wars around the world and other macro and interest rate factors, just puts you at a disadvantage. Don't spend too much time about it. Certainly don't start getting into forecasting economic trends, but be aware. And these are the 10, and here's number 11. Failing to think like an activist investor. I want all of you to put yourself in the mindset when you buy a stock as the owner of that business. I want you to put yourself in the role of a shareholder who is activist. What does that mean? I don't want you writing letters to management, although it is somewhat cathartic to fire off and not send a letter. If you, as a successful entrepreneur in your own right, as a successful student, whatever you do for a living, you can tell whether or not a company's being run well. Let's take an example. Suppose you wanted to be an activist investor in a restaurant like McDonald's, and you realized that there was something on the menu or there was some aspect of their service that you didn't like. Well, start to think about what an activist investor would pen in their note. There's great activists out there. I think that a study of the Carl Icahn types of the world, the way T. Boone Pickens was, Bill Ackman, there's many others, Jeff Ubben. These are people that I admire because they have taken the shareholder responsibility extremely seriously. They've gone after companies, not just for what they call green mail purposes, but they've thought, like Warren Buffett, that they're truly owners of a fractional interest in that business. And if they see something wrong with that business, they, in many cases, have started proxy battles. You don't have to get that intense about it, but one thing that you would want to avoid is to fail to think like an activist investor and fail to think like an owner. So here are the top 11, the things that I'd like to avoid this year. I think you should avoid this year in summary. And as always, I thank you for joining me. And if there's any you'd like to add or any you'd like to argue about, let's talk. But happy 2025.